Hey, here's the latest on what's actually happening with the real estate market and what could happen going forward for those of you curious about what's happening. Now, some of you have been asking me, Kevin, why is it that areas like in Phoenix, Arizona, where Open Door is losing money on 70% of the listings they're trying to flip, why is it that certain areas like Boise, Idaho, or parts of Florida are seeing so much more of a dramatic downturn potentially here in real estate than other areas? And a lot of this is simply explained by the reversal of COVID trends, right? When we had the pandemic, we were working from home, so we may as well work from home from an area of cheap housing and cheap living and cheap state income taxes. Some of that is reversing now as companies and corporations are requiring hybrid work where people move back and closer to where corporate campuses are. Now, in some cases, like for example in Sunrise, Florida, you actually have headquarters of companies like American Express moving there or have moved there in the last 5 years and are encouraging hybrid work from those locations. So typically people would want to live around those. But other areas just don't have that luxury. For example, potentially Boise, Idaho doesn't necessarily have the luxury of suggesting that sure, no matter what company you work at, you can do hybrid work here because, oh, wait, we don't have your office over here. So some areas, as we expect the entire real estate market in the United States to slow down, some areas are going to slow down faster than others. So it makes sense that if somebody wanted to cherry pick just the ugliest news, of course, some areas are going to slow down more than others. But what I want to understand is what's sort of happening on a nationalized basis and a broad basis, because that, in my opinion, gives us a smoothing out of what's happening with COVID trends, and instead just lets us know what is the direction that real estate is going in nationally. Now, we know that a lot of real estate is based on what happens with interest rates. And what's really neat is you could see that on this particular chart right here, you could see real estate prices for 2022, while they do seasonally tend to fall, as we saw in 2021 and 2019 around the summer months, we have seen a little bit more of a decline here in real estate prices in 2022 so far, from 392 to about 367, 366 here right around the lows. That works out to about a 6% decline in national real estate prices. Now, what's actually really neat about this, though, is that we see this plateau in home prices falling here at the beginning of August. And what's neat is when we look at mortgage rates, we actually have this plateau of mortgage rates right around the beginning of August. So look at that. Right as mortgage rates plateaued, or around the time that mortgage rates started coming down, since it generally takes about 30 to 45 days for real estate to close, as we saw mortgage rates peak in June and then start trending down, real estate prices actually plateaued and they flattened, which is really, really neat because it shows that, okay, maybe we only see about a 6% decline in real estate prices nationwide when rates are around 5%. Now, the problem with that is rates have recently moved to about an average of 6.7%. That is, of course, not yet reflected in this chart here in prices because it takes, again, 30 to 45 days for these deals to close. But where you can actually see that sort of pain of these higher yields or higher rates being priced into the market is right here. You click on the little price drops category here and look at this, folks. If you just look at 2022, which is the black line here, you could see that property listings and price drops were highest right around the first week of July, which is right when sort of interest rates were at peak and were starting to come down. That's when interest rates were at their highest levels in the summer, and that's when price drops were at the highest level. Then we had sort of this bottoming here, the first week of August, and that's when price drops relaxed. And now look, folks, rates have skyrocketed again. And what are we seeing again? Price drops across the board. This is a leading indicator, in my opinion, that median sales prices are likely to fall again. So median sales prices, again, here, plateaued right after interest rates peaked and they started going down. This actually led to a surge in August of new home sales because people thought, oh, look, real estate rates have peaked. Let's get in now before rates go up again. Sure enough, rates went up again within a month. And so that does mean we probably still have enough national momentum now with rates up high again to push real estate down a total of 10 to 15%. Now, there is some good news. The some good news we have is that the 10-year Treasury yield here has started to potentially peak again. Now, mortgage rates tend to follow the 10-year Treasury yield, and the 10-year Treasury recently hit as high as 3.9%. Almost 4% is what you were making risk-free on Treasury bonds. And when there was an indication that maybe we have officially hit peak on these Treasury yields, we started noticing them come down. Now, the 10-year is only sitting at 3.6%. Now, anything above 2.75 is pretty bad for real estate, and when mortgage rates peaked in the summer, we were sitting around 3.4 as a 10-year Treasury. You could actually see that chart here, that we're still a little bit higher now than where we were in June. See that red dotted line shows you we're still a little bit above that peak in the summer. So that does mean we still have a continuation of that pain that we were having this summer, and we'd expect prices to continue to fall. But the good news is we've come off the peak with the 10-year Treasury, and maybe that means less damage to the real estate market, especially if this continues to trend down fast. And this is very, very important for me to pay attention to, especially, but also you if you're thinking about buying real estate, because we are starting a company called HouseHack. It's a startup that will invest in real estate. It'll buy wedge deals, below market value, fixer-uppers or multifamily wedge deals, single-family, long-term rental, short-term rental, multifamily, everything, right? You can go to househack.com because this is not a solicitation. You could go there and you can sign up, just upload your W-2s and your proof of income that you're an accredited investor, or go to househack.investready.com to get an accredited investor certification, and you can invest in HouseHack. So the beautiful thing about this is that we can watch the 10-year to really predict what's going to happen in real estate. I showed you this correlation that's nearly perfect between real estate mortgage rates and prices. And so if the 10-year is moving down and mortgage rates align with the 10-year, then as the 10-year moves down, we could actually start hopefully seeing some optimism that real estate prices have found their bottom. So what happens with this 10-year is going to be critical, though, because much like any market, this 10-year moves up and down like crazy. If tomorrow this goes back to 3.8 or 3.9% over the next few weeks, we're going to continue to have more real estate pain for longer. If this 10-year Treasury yield plummets and goes down to, say, 2%, we probably will see a very quick bottoming of the real estate market. So if you're wondering how bad is real estate going to get, I don't think looking at areas like Arizona or Boise, Idaho, or Austin, Texas, or Florida is really going to give you the best outlook in terms of what reality is. I think reality is predicated by this 10-year chart. Where we sit right now is painful. It will probably mean prices will be down 10 to 15% by next quarter one, by March and April of next year. However, if the 10-year Treasury all of a sudden plummets, we could actually see that 10 to 15% start creating a bottoming in the market, and we could actually start rising from there. And maybe we end up seeing a bottom in real estate towards the end of this year, December, January, February, much earlier than expected. A lot of this is obviously going to depend on what the Federal Reserve does and inflation does. If we get another bad inflation report, and then the Fed raises rates even more aggressively, this 10-year is likely to spike again, leading to, again, more pain in real estate. But anyway, now you have a clear outlook in terms of what to expect for real estate. If you found this helpful, consider sharing the video and subscribing, and we'll see you in the next one. Thanks so much. Goodbye.